Hey there, and welcome to the Tax Sell Podcast. My name is Denman. I am your host. I am the founder of the Tax Sell Academy and the author of the Tax Sell Playbook. I'm so excited you decided to join me today. Today I want to talk about a question that I get quite a bit. If I buy a tax sale property, will I get stuck with the mortgage? You know, it comes up constantly, whether somebody's buying a tax lien that they plan to foreclose in the future, or they're buying a tax deed, or even an OTC property. Or maybe they just heard about the business, but on their mind is this mortgage, this lien, whatever it is, that they think they'll be stuck with. And I get it, it's completely fair concern. The last thing you want to do is to buy a cheap property only to discover that you're stuck with a leftover $200,000 mortgage that you now have to pay for. Here's the thing, that is not how it works. In fact, I recently saw a clip where Dave Ramsey, yes, the financial guru guy Dave Ramsey, made a completely false statement about tax sales and liens and how you would buy a piece of real estate at a tax sale and you would inherit that lien and you'd be paying monthly mortgage payments. Let me say this and be as clear and respectful as possible. Dave, you are absolutely 100% wrong. You have no idea what you are talking about when it comes to tax liens and tax deeds. The laws are very, very clear. Let's break it down. Here's the truth. In most states, property taxes create what is called a superior lien, a priority lien, a senior lien, super lien, whatever you want to call it. The terms vary, but this means it is the most important lien against that property. So, property taxes are more important than the mortgage. Property taxes are more important than mechanics liens. Property taxes are more important than pretty much any other claim against that property. Why is that? Why would the laws state that they have such seniority? Well, because the government must be able to collect taxes in order to function. You know, if private banks and contractors could block or override the government's ability to collect those taxes, things would collapse all around us. So here's the deal. When a tax lien is foreclosed, it's generally going to wipe out all junior liens. Mortgages, gone. Credit card judgments, gone. Mechanics liens like plumber's liens, gone. If it comes after the tax lien in the chain of priority, if it's a junior lien to the senior tax lien, it's almost always going to be extinguished during the tax foreclosure. And listen up, because I'll get into some detail about this. But when it comes to tax deeds, same thing. So a tax lien, you have this lien, you foreclose the lien, it wipes it out. Tax deeds, same exact thing, except for you bought it after it went through the tax lien foreclosure process. So regardless, it's the same thing. The tax deed is going to be issued by the county or the municipality. It's going to be free and clear of private party liens. Again, mortgages, private party liens like mechanics liens, they're not going to be attached to that property anymore. You're getting the property, you are not getting the debt. Here is the exception. Governmental liens. One government agency is not going to override another government agency. So if there's a code enforcement lien, a demolition lien, or something similar that's in favor of a governmental agency, that lien will stay attached. So if you see something like a $500 fine for code enforcement that is a lien recorded against the property, it's going to stay. If you see that the county's been mowing this property for the past 10 years and they've got a $3,000 mowing lien against the property, it's going to stay. If you see that you're buying a vacant lot that just last year had a house on it that the county tore down and they now have a lien against that property for those demolition costs, it will stay. So beware, you may be responsible for those after purchase. Now, there's ways to negotiate and all that kind of thing, but you need to understand what you're going into when you buy a piece of real estate. If it's a lien from a government agency, expect you will need to pay it. That is one of the reasons I always recommend a lien search before you buy. It's not complicated, and you can even do it yourself. I actually have a complete training inside the Tax Sell Academy called Tax Title 101 that shows you how to do this. Essentially, you go to the county's official record site, you search by the owner name or potentially even the parcel number, and you look for recorded liens. You look for judgments against that property, and then you figure out the seniority based on your state's laws. Now, there's other things like notices of commencements, building permits, that kind of thing, which can really help you when it comes to not just looking for liens, but learning about the property's history to get a full picture of that property. You might even find things like insurance claims, like a sinkhole claim that was made against the property. Maybe deeds were written incorrectly, is like DIY type stuff, which can really cloud things up. Maybe it's recorded permits for a recent roof replacement or a recent HVAC replacement. There's all sorts of other fun documents in the chain of title that can really help you out. So all these can help you understand what you're buying, but more importantly, can help you avoid the hidden risk. Now, a lot of people skip this step. Don't. It's one of the simplest ways to protect your money in this business. And truly, it's very, very easy once you learn how to do it. So take the time to learn how to do it. If you're in the academy, by all means, go through Tax Title 101. If you're not in the academy, figure out a way to learn how to do it. And don't rely on an attorney or a title company and have them research every single property you're interested in at $75 or $150, because I guess it's very, very cost prohibitive if you go that route. And it's truly very, very easy once you learn how to do it. Now, there are a few states where the laws allow private party liens to survive. An example would be something like a Pennsylvania upset sale. So Pennsylvania upset sales are properties that went through tax foreclosure and they are sold at the first tax sale. Those are not cleared of liens. They'll have a second sale, judicial sale after the fact, which is clear lien. But if you buy it at the first tax sale, all private party liens remain. So a lot of the smart investors that don't want to deal with liens, they'll wait for that free and clear sale before buying. New Mexico is another area where some liens do survive depending on the foreclosure process. And then there's other states as well, depending on how specific notices we're giving, that kind of thing. So, which takes me to the next thing, and that is that you need to know your state's laws. Every state has its own rules and statutes, and those are the playbook that we operate as tax sale investors. And they'll tell you what type of liens are wiped out, what survives, how notices are handled and how important they are there, what redemption rights might exist, how the title is transferred. You don't have to go out there and memorize every single state's laws, because a lot of those laws have quite a bit to them. I've been investing in many, many states for more than 2 decades now, and there's still times where I need to go and I need to reference those state statutes in a specific state that I'm investing and just see how they handle some stuff. But you do need to know you have the ability to do that. You can go online. If you're in the Tax Sale Academy, you can go to the resources we provide on your member dashboard. If you're not, you can search the state statutes related to tax liens or tax deeds in the state that you are investing in. Read through those prior to investing there. And again, reference them when you have any sort of a question, because that is what prevails at all times. It's a state statute. The state statutes allow this business. It allows us to make money as tax sale investors. Knowing these laws, knowing how to research them, that's kind of just part of being a professional. That's how you protect yourself and how you protect your money. So let's recap this real quick. Tax liens and tax deeds will extinguish mortgages and private party liens in most scenarios. Governmental liens often remain attached, so be careful of those. Make sure you do a lien search if you want to know the full story about that property. Know your state statutes. At least take the time to read through them once or twice, and by all means, reference them when you have any sort of doubt or any sort of questions. And lastly, do not follow the advice from people who don't know this business, even if their name is Dave Ramsey. I've been doing this for 22 plus years now. I've bought thousands of properties. I can tell you the laws are very clear if you take the time to read them. Now, I'm not sure what applies in your area, but start reading or get some help. Never assume. I truly hope this episode of the Tax Sale Podcast has helped you out. For more information on tax sale investing, make sure you check out taxsaleacademy.com. Hey, take care, folks, and we'll see you next time right here on the Tax Sale Podcast. Bye-bye.